Welcome to Talk Tickers, your essential service cutting through the noise of earnings season. Today we're doing a deep dive into Macerich's, ticker MAC, their Q2 2025 results.
Right. They reported after hours, August 11th.
And on the surface, you look at the numbers, a little messy, right? A miss on the bottom line. Usually that's not great news for a stock.
Usually not, no.
But the next day, the market reacted pretty positively. The share price was up, 4.6%?
Yeah, 4.6% by the close. So clearly investors were looking past that miss.
Exactly.
Yeah.
So our mission today is to figure out why. Why ignore the quarterly miss and focus so hard on Macerich's multi-year plan?
Well, it's a classic case, really. The story, the narrative, it just overshadowed the immediate financials. If you just glance at the short-term snapshot, it's definitely a mixed bag.
Okay, break it down for us. What looked good?
Revenue was strong, came in at $249.8 million.
Okay.
That beat consensus by about $8.1 million. And, that's a solid 15.9% year-over-year growth. So top line, great.
But the profit metric for a REIT, that's FFO, right? Funds from operations. That took a hit.
Exactly. FFO is key, adjusts for things like depreciation. And yeah, their non-GAAP FFO per share was 32 cents.
And consensus was expecting?
Consensus was $34. So a 2-cent miss, not huge, but, a miss is a miss.
And occupancy, that's always critical for malls. I saw a dip there too.
That's a crucial point, yeah. Portfolio occupancy, it dropped 60 basis points quarter over quarter.
So 0.6%. Down to 92% overall.
Right. And management was quick to frame that. They said, look, this was intentional, mostly driven by the planned liquidation of Forever 21.
They closed all their remaining stores in Macerich properties.
All of them during Q2. So yeah, they knew that vacancy was coming.
So they willingly took an occupancy hit. Sounds kind of risky.
It does, yeah. But here's where the narrative, the story, starts to really take hold. Despite that dip, the core operational metric everyone watched, net operating income, or NOI, for their main go-forward portfolio.
The assets they plan to keep long-term.
Exactly. That actually grew 2.4% year over year.
Okay, that's solid.
And maybe even more telling, their re-leasing spreads on a trailing 12-month basis stayed strong. Positive 10.5%.
Wow, 10.5%.
Yeah.
And how long have they kept those positive?
This makes 15 straight quarters, 15 quarters of positive spreads.
So even when tenants leave, the new ones coming in are paying significantly more rent. That shows real pricing power.
Precisely. That's the engine. It tells you the underlying real estate is high quality, high demand.
So the market saw that, saw the NOI growth, the spreads, and basically said, okay, we believe the plan.
That's how it looks. The stock jumping 4.6% signaled that this path forward plan, as they call it, convinced investors. The long-term gains outweighed the short-term noise from FFO and occupancy.
Okay, let's dig into that path forward plan. It's about simplifying the portfolio, improving operations, cutting debt. Let's start with operations, specifically leasing. Sounds like they're firing on all cylinders there.
Aggressive is maybe putting it mildly. They had a goal, right? Sign 4 million square feet of new leases for 2025 and 2026 combined.
Right, a 2-year target.
Well, as of the end of Q2 2025, so just halfway through the first year, they've already signed 4.3 million square feet.
Already. So they blew past the 2-year target in 6 months.
Pretty much. 650 individual leases signed. They are way ahead of schedule on volume.
That's impressive volume. But signed leases don't mean rent checks tomorrow. That brings us to the SNO pipeline. What's S stand for again?
SNO is signed, not open.
Sure.
So the lease is done, it's binding, but the store isn't open yet. Tenant isn't paying full rent quite yet. It's basically future growth already locked in.
And how's that pipeline looking?
It surged. It was about $75 million last quarter. Now, $87 million.
Okay.
And management's now targeting to get over $100 million in that SNO pipeline by year end.
And how significant is that $87 million? Put it in context.
It's about 12% of the total pro forma NOI for their core portfolio, which they estimate around $720 million. So it's a really big chunk of guaranteed future revenue coming online, over the next 18, 24 months or so.
So that's the inflection point they keep talking about, when that SNO starts converting.
That's the idea.
Let's go back to Forever 21 for a second. That drove the occupancy dip. Management called it an opportunity to remshandize. What are they doing with all that empty space?
Well, they pointed out that while Forever 21 took up a lot of square footage, the rent was pretty low. Financially, it wasn't very productive space.
Deadweight almost.
Kind of. And the key insight they shared is they expect to more than double the rent Forever 21 was paying once they backfill those spaces.
Double the rent. Okay, that definitely justifies taking a temporary vacancy hit. Do they have tenants lined up? That's a lot of space.
They've de-risked it quite a bit. They said just over 50% of that closed square footage already has commitments or signed leases.
Halfway there already.
And another 30% is currently in the LOI stage, letter of intent.
So 80% is basically spoken for or close to it.
Exactly. So clearing out that low rent space lets them really upgrade the tenancy, and it ties into this bigger shift in their anchor strategy too.
Right, moving away from struggling department stores towards more destination retail experiences, that kind of thing.
That's the focus. They mentioned having roughly 28 vacant or unproductive anchor opportunities across the portfolio they're going after. This is the really heavy lifting.
Big boxes.
Huge boxes. The example they gave was signing Dick's House of Sport at Washington Square in Portland.
Dick's House of Sport. Okay, how big is that?
142,000 square feet. Going into a massive empty former Sears box. That's transformative for a center's traffic.
Absolutely. But reconfiguring a giant old Sears box? That sounds expensive. We must be talking high tenant improvement costs, TI capital.
You nailed it. Management was up front. TI and landlord work costs are expected to keep rising.
Because it's not just paint and carpet.
Not even close. You're talking complex structural changes to buildings that might be decades old. Imagine a 3-story Sears box designed as one unit, one utility feed.
Right.
To turn that into, say, a Dick's, maybe some restaurants, maybe entertainment, you have to reinforce floors, run new separate utility lines, put in new escalators, maybe even punch new entrances through exterior walls.
Okay.
It's incredibly complex. That's why the CapEx is high. But, that's the investment needed to get those 10.5% spreads and really change the game at these centers.
So the cost is high, but the return is turning like a B- building into an A+ income stream.
That's the bet.
Let's pivot then to the broader strategy. Okay. 2 parts, right? Selling off assets to refine the portfolio, and then targeted growth through buying new ones.
Right. And the big news on the buying side this quarter was Crabtree Mall.
Crabtree, where's that?
Raleigh, North Carolina. High growth market. They bought this Class A asset for $290 million.
Okay, $290 million. What kind of return are they expecting?
This was interesting. They're projecting an initial yield or cap rate of around 11%.
Wait, 11% on a Class A mall in Raleigh in this interest rate environment? That sounds really high, almost too good to be true. What's the catch?
That's the right question. The catch, or the opportunity, depending on how you see it, is the occupancy. It's currently pretty low for a Class A asset, only about 74% permanent occupancy.
Okay, so they're buying into a leasing challenge.
Exactly. Significant execution risk. But they have a clear plan. Get that occupancy up closer to 90% by 2028.
And if they do that?
If they hit that target, the NOI growth is massive. It makes that $290 million purchase price look very, very attractive in hindsight.
Are they putting money in to help lease it up?
They are. They financed part of the deal with a new term loan, about $160 million, 2-year term, SOFR, plus 250 basis points.
Okay.
And they're earmarking about $60 million of capital right away for reinvestment, upgrading common areas, fixing up the parking deck, making it shine to attract those new tenants.
So buying smart, but also aggressively cleaning up the balance sheet. Let's talk deleveraging. Where are they on debt?
Making real progress there. Net debt to EBITDA is now at 7.9 times.
Which is down from
the high 8s when they started this path forward plan. Their long-term goal is to get that down into the low to mid 6 times range over the next few years.
Closer to investment grade territory.
Much closer. That's the target.
And how are they paying down that debt?
Yeah.
Selling assets, I assume.
Absolutely. That's the main engine for deleveraging. They've completed or have under contract over $1.2 billion in asset sales.
Like which ones?
Properties like South Park, Atlas Park, Lakewood, Valley Mall, names people might recognize. They're well on their way to that $2 billion disposition target they set.
Okay, so leasing is ahead of schedule. Leverage is coming down. They just bought a high-yield asset. Execution seems strong. So why no formal guidance for the year? Analysts usually don't love that uncertainty.
Yeah, they addressed that. It really comes back to those asset sales. Management basically said the timing on the remaining sales is still fluid. It's uncertain exactly when deals will close. And when you sell an asset, the income stops immediately.
Oh, right. Creates lumpiness in the earnings.
Exactly. Significant disruption quarter to quarter. So they'd rather not put out specific guidance numbers that might have to change based purely on, whether a sale closes in Q3 or Q4.
Makes sense. Focus on the underlying trends, not the timing noise.
That's the core message. Don't get hung up on the quarterly FFO impacted by sales timing. Focus on the goal. That multi-year NOI KGR compound annual growth rate of about 5.2% for the core portfolio.
And wait for that big inflection point in mid-2026 when all those S&O leases finally turn into rent-paying tenants.
That's the payoff they're driving towards.
Okay, so pulling it all together for the listener, what's the big takeaway here? It seems like management is saying, look, we're going to prioritize fixing the ship, getting the portfolio right, even if it means the quarterly numbers look a bit messy for a while.
That's a good way to put it. They're sacrificing some short-term FFO smoothness for long-term value creation, turning those, let's call them C's assets, into cash to reinvest in A assets like Crabtree.
And the market seems to be buying it for now.
Yeah, in this higher for longer REIT world, REIT multiples are under pressure. So the strategy that gets rewarded is this one. Aggressively prune the weaker, non-core stuff, what they sometimes call the Eddie assets. Yeah, sort of a code name for the ones they're less attached to. Prune those, reinvest in the high-quality, high-growth Fortress's assets. That's the path to getting the stock re-rated eventually. They're playing the long game.
Okay, good setup for our next segment. This is not financial advice. Remember, everyone, we're just discussing ideas based on the tall. Definitely not recommending you go out and do this.
Absolutely not financial advice.
So we're pitching a high conviction, maybe outrageous but plausible trade idea, tying together these themes of strategic investment and aggressive deleveraging. What have you got?
Okay, we're calling this one the go-forward arbitrage trade.
Go forward arbitrage. Okay.
The thesis is simple. Your betting management pulls this off. They complete the portfolio cleanup. They hit the deleveraging targets. And that 2026 inflection point actually happens.
Okay. Pure bet on execution. How do you structure the trade?
It's a two-parter. First, you take a long-term, deep-in-the-money call option position on Macerich stock itself.
Deep in the money call, so less leverage, more delta. Timed for.
Time to capture that mid-2026 expected NOI surge, maybe looking out even a bit further, coinciding with hitting that $2 billion disposition target. This gives you leveraged exposure to the upside in the core Fortress's assets.
Okay, that's the long side, betting on the good stuff.
Yeah.
But what about the risk from the Eddie's assets they still need to unload? How do you hedge that?
This is the interesting part. You pair the long equity calls with a structural short position against a specific slice of the CMBS market.
CMBS, commercial mortgage-backed securities. Explain that.
Right. These are bonds backed by mortgages on commercial properties. You specifically target the CMBS tranches tied to the lowest rated, highest risk assets that Macerich has basically signaled they're willing to dispose of or even just hand back to the lender.
So you're shorting the debt on their weakest malls.
Precisely. The idea is, as Macerich executes its plan, some of these Eddie's assets might underperform. Loans might default. Like the Santa Monica Place loan they mentioned is already in default. When that happens, the value of the CMBS bonds specifically backed by those properties takes a hit. So shorting that specific debt segment hedges the risk and the capital costs tied up in managing or disposing of those problem assets.
Wow. So you isolate the bet. Long the Fortress's upside via options. Short the Eddie downside risk via targeted CMBS.
Exactly. It's an arbitrage between the value they're creating in the core and the value they're shedding, sometimes painfully, from the non-core. It's a bet on the process of portfolio transformation itself.
That is definitely a complex trade. Fascinating idea, though. Again, folks, not financial advice.
Definitely not. High risk requires expertise in CMBS.
All right, quick recap then. It's Macerich Q2. Headline numbers missed, occupancy dipped, but the underlying operational metrics like NOI growth and leasing spreads looked strong.
And the strategic narrative, cleaning up the portfolio, deleveraging, reinvesting in high-quality assets like Crabtree, clearly resonated with the market.
Hence the stock pop, despite the FFO miss. Management is playing the long game, sacrificing short-term optics for strategic positioning.
Right. And maybe a final thought for you listeners to chew on, given how much they emphasized anchor re-tenanting and the complexity involved.
Yeah?
Which specific big redevelopment project should you watch most closely as, like, the bellwether? The one that really proves if this 2026 inflection point is real?
Probably that huge Sears box conversion at Washington Square they talked about.
That would be my pick. Watching how that Dick's House of Sport project goes, the cost, the timing, the impact on traffic, that could tell you a lot about whether the whole strategy is on track.
A great point to focus your ongoing research, something tangible to watch. Okay, that's our deep dive for today. Thanks for joining us. We'll see you next time on Talk Tickers.